up, home buyers? Today's video is all about mortgage debt and how to use it wisely. I'm John Cunningham, full-time real estate agent right here in sunny Phoenix. You see, the trick is how to use mortgage debt in a wise way. And that word debt just bugs us. And frankly, it should. For the most part, we have too damn much of it. So let's turn the tables on debt. Let's use it to our advantage. Let's cut that 30-year mortgage in half. Let's figure out how to become debt-free. Let's figure out how you can own your house and owe no man anything. My buddy Tom owns Market Line Mortgage. He's been in the money business for 30 plus years. So Tom is a really good guy to talk to. So listen in as Tom and I talk about mortgage debt. Stick around to the end and we'll show you how you can get your one-on-one personal consultation with Tom. Do that, and Tom will even reimburse you for your appraisal when you finance your home through him. That all by itself is worth somewhere between $500 and $600. So come on, let's go talk with Tom. So Tom, what's the first step that you take to figure out how much mortgage somebody qualifies for?
Right. So I think everybody out there has sort of started to garner that we look at gross income, not net income. So for an employee, it is that income prior to any taxes coming out, or hourly wage before any taxes coming out. So they get to qualify off that high end number. I think where you found that a lot of the millennials that are now coming into the buying stream is that they aren't pushing that maximum for their debt ratio. So some systems will allow, depending on what other debt they bring into the scenario, could be 45% of their gross monthly income could get approved, and not the wisest choice. I mean, when you look at gross income, you're going to lose 20 or 30% off the top, right? And then you've got some housing expenses and foods and entertainment and everything else that you can get down to needing much more than that left over from that mortgage payment if you go too high. So I think generally speaking, if you look backwards, you'd say that 28 to 30% of your gross monthly income to that house payment is a good start point. If you have super low debt and everything else, you might be able to push that a little bit higher. But the smart population right now, what they're doing is they're starting to realize, I want to have a life. I don't want to be strapped to the house. And so with doing so, they're really keeping those payments lower, which is they're not buying as expensive of a house, but they're being smarter with their money.
Yeah, for sure. And you know, a lot of people are feeling like they've really got to get this thing figured out right now, because one of the things that anybody who's been renting for any period of time realizes is that rents have gone up a lot in the last couple of years. Last year, rents went up 8% in the Phoenix metropolitan. And when you are a renter, you don't have any control over that payment. So if you can figure out how to make a purchase of a home, a condo, a loft, even a tiny home, whatever it is you're going to buy, if you can figure out how to buy something that's within your budget, then you're going to be able to control those expenses. You know, you can't control taxes. You can't control utility costs, but you can fix your overall house payment by getting a mortgage. So, you know, mortgage debt can be good too, especially if you're able to protect that payment from being able to get out of control.
Right. Yeah, I think a lot of people, John, have gone away from back before we had the problems starting in 2008 or so. You don't find that the adjustable rate mortgages are that popular. Most people are going 30-year fixed. We have a lot of people refinancing out of 30-year fixed, even into 15-year fixed.
Oh, you do?
They can secure it. They know what they've got, but the adjustable rates just aren't that popular.
Well, let's talk about the 15-year fix. Let's talk about what happens payment-wise. Like, how much of an increase is it over a 30-year fixed? Is there a rule of thumb, like a percentage that we can
I would
apply?
tell you it's about 1.5%. So if you take the principal and interest of a 30-year fixed and the principal and interest of a 15-year fixed, rate is always going to be better on the 15 compared to the 30. So you do get that savings, but the payment adjustment is about 1.5 times what the 30-year fixed payment is.
Okay, so you're going to have a higher payment. You're going to get the house paid off faster.
But John, just to
Refinancing.
add to that,
Sometimes
the one thing
people-
you have to remember is that the interest savings is hundreds of thousands of dollars to the borrower to go with that 15 versus the 30. So while the payment is higher, there's a significant financial benefit for them to go to that 15 if they can.
Okay, what about refinancing, Tom? Sometimes there are great reasons to refinance. For example, if the rates drop, and sometimes you can pay off some other debt with it. But it seems like refinancing is one of those things where people lose control over their overall financial goals, where they're, borrowing from their house too often in order to uh, be able to continue to spend money like it's grown on trees, right? That does
Right.
happen.
Well, I mean, I can tell you firsthand about some clients that I think, and I spend a lot of time counseling borrowers, and I'll have a lot of borrowers, past clients call just to ask questions to inquire because I think they trust the advice I'm going to give them more than just trying to get them to do another refinance. But I think you can use it wisely depending on cash flow. Some people are strapped, maybe on fixed income, and to refinance to take cash out to pay off some other debts is really beneficial because their monthly cash flow is so much better. Other people, unfortunately, use it more like it's a piggy bank. And so they go over and over and over into the refinance market, which is sad to see because you find that they're dwindling away their equity. And then the next time they call, they've run all their credit cards back up again. So they're doing the same thing, a year to 2 years later. And that's the borrower that you feel sad for because you don't want to see them financially hurt themselves long term because they're not thinking about it today.
Here's a question, Tom. How can a young person, well, any person, but I'd really like to see a young person take on the mindset of being able to be debt free as soon as possible. And you know what? That's not completely unrealistic. In today's world where student loan debt is really high and that sort of thing, taking on a mortgage just is, an additional expense. But, we can't live in tents. We got to live somewhere. And if somebody wanted to, if they're able to figure out how to get a property, get a 15-year mortgage or a 30, how can they accelerate the payoff so that they can be debt free of any monthly obligations that are significant?
I think that's a great question. So what we do a lot, so some borrowers, they feel comfortable with the 30-year fixed payment. They don't feel comfortable locking themselves into that 15-year fixed. But what we'll do is we'll tell them a couple of ways to pay that 30 down much quicker. So number one is if they make one extra mortgage payment a year, that will shave about 7 years off of that mortgage. So that 30-year becomes somewhere in the neighborhood of 23 years to pay off. And also, I can tell them at the start point what the 15-year fixed payment is. So what they can do is make that 15-year fixed payment every month that they can. But if something happens, they have an automobile fix or a leak or whatever that they've got to use some of that cash for, go back and just make the 30 for that month. But try to continue to accelerate those payments as much as possible to get you down and paid off as fast as possible is the right move financially.
Man, that sounds good. So if you pick up a 30-year mortgage and you just want to treat it like a 15-year mortgage, all you got to do is change the payment that you make to what a person who had a 15-year mortgage would make. And then if you do have a month where money's a little bit tight, maybe it's Christmas time and you're buying the kids gifts or something, at that time, maybe you relax back to the normal 30-year payment. But if you make all your other payments a 15-year type of a payment amount, then you're going to be able to accelerate the payoff on that loan significantly.
Yeah.
And then I like that. Make one extra payment a year, pay your mortgage off 7 years early. That's an easy thing to do. Everybody's going to run into a little windfall of cash at least once a year, and super smart way to do that. And if they were to make a couple extra payments, what would happen?
Well, so to answer, so the second question, all of a sudden you can get that 23 years down into the probably 17, 18-year period of time. But the nice thing about the windfall is that, maybe it's a tax return amount that you can take and apply to the mortgage because you get that every single year. Maybe they get Christmas money, something. And that's the easy way. And I like our borrowers controlling when they make that extra payment instead of locking themselves into companies that kind of try to sell you on a program. of how they make the quarterly payments or the semi-monthly payments for you. So I like trying to find what's the path of least resistance and what's the cheapest way for our borrowers to have the same benefit.
One of the things I have noticed when people are starting this buying process, a lot of times they haven't had a conversation with somebody that they know and trust yet because they just don't know anybody in the business. So sometimes they'll fill out something online and start talking to a mortgage company that's just pure online. And when you do that, it's kind of hit or miss, right? You never know what loan officer you're talking to. It might be a brand new person just plugged into a system. You may not be able to get advice. You might be able to get some quotes, but you may not be able to have much of a conversation. And so I always love that about you is whenever I have somebody who's starting off the process, the first thing I want to happen is to see them have a conversation with you because, it's important that they know that, hey, we're actually real human beings and we have thoughts and ideas and we'd just love to spitball some ideas with you and talk to you about finance and mortgage and the different options that you have. And so if somebody wanted to do that, how would they best be able to get a hold of you?
So I think they can try to contact us in a number of ways, whatever is easiest for them. They can call, obviously phone number 480-967-8286 extension 1 for me directly. They can go on our website and send electronic messages. They can text me on my cell phone if they want to go that route. So really any way that they want to start that dialogue, we're available to kind of meet that need for them.
That's awesome, Tom. And also wanted to let you know that I've got two other videos for you to check out. One is about conditional loan approval, and the other one is about the physician's mortgage loan. We'll see you there.